In an uptrend, a pullback remains valid as long as it does not break the previous higher low. In a downtrend, it must not break the previous lower high. When the market structure is broken, it often suggests that the trend may be losing momentum or could be coming to an end. Trading pullbacks that violate these key levels can be risky, as the price may reverse sharply against your position. Understanding this helps you stay on the right side of the trend and avoid unnecessary losses. Summary, easy to remember. A pullback is valid when 1. Trend is strong. 2. Pullback is weak and slow. 3. Stops at support resistance or trend line. 4. Volume decreases. 5. Strong rejection happens. 6. Trend structure stays intact. Pullbacks can be classified into 3 types: aggressive pullback, moderate pullback, extended pullback. Let's take a closer look at each type and examine how understanding them can help us incorporate a systematic approach into our trading strategy. The first pullback type is the aggressive pullback. An aggressive pullback is a corrective move that retraces quickly and strongly against the prevailing trend. Unlike a normal pullback, it shows high momentum from counter-trend traders or profit takers, which can signal weakening trend strength or even a potential trend reversal. An aggressive pullback is characterized by sharp, rapid price movements over a few candles, often accompanied by long-bodied candles that indicate strong selling in an uptrend or strong buying in a downtrend. These moves usually happen on high volume, reflecting genuine market conviction, and can break the existing trend structure by violating previous higher lows in an uptrend or lower highs in a downtrend, signaling that the main trend may be losing control. We will now explore how an aggressive pullback influences trading decisions and market behavior. An aggressive pullback can be a warning sign. The trend might reverse. Traders often wait for confirmation before entering in the direction of the original trend. Some use it as a trading opportunity if they spot a strong rejection at key support resistance or trend lines. To use aggressive pullbacks to enhance your trading plan, you basically leverage sharp, high momentum reversals in the market to identify potential entries, exits, or trend continuation points. Here's how you can structure it. Aggressive pullbacks are sudden, strong moves against the current trend, often with long candles and increased volume. Watch for these in charts because they indicate traders are testing the trend's strength. Combine with key zones. Use demand and supply zones, areas where buyers or sellers previously entered the market strongly. When an aggressive pullback hits a demand zone in an uptrend or a supply zone in a downtrend, it can act as a bounce point, giving a high probability entry. Confirm trend structure. Look for a break of structure, BOS. If the pullback breaks a previous high or low, it may signal a trend reversal. If the BOS is not confirmed and the price respects your zone, it reinforces a continuation trade. In this scenario, enter near the demand supply zone after confirming the pullback slows or shows a rejection, like a wick or reversal candle. Keep your stop loss just beyond the zone or the extreme of the aggressive move to avoid being stopped out by normal volatility. Take profit in phases, ideally near the next key structure or zone. Aggressive pullbacks often come with high volume. If volume is unusually low during the pullback, it might just be a normal move, not a true aggressive pullback. Prioritize trades with strong volume signals. In short, aggressive pullbacks act as both entry triggers and trend confirmations when combined with zones and BOS. They help your plan by giving structured points to enter or exit without guessing. Note, when price enters a demand zone with high-speed, strong candles, it may not necessarily react. You shouldn't assume the zone will hold without signs of slowing momentum. Waiting for confirmation is essential, as entering too early during raw momentum can be risky. To avoid getting caught when price rushes into a demand zone with strong momentum, wait for the movement to slow down and show signs of hesitation before entering. Consider scaling your entry instead of committing fully. Set a stop loss just beyond the zone to limit risk. And if momentum is too strong with no clear reaction, it's often safer to skip the trade and wait for a better opportunity. Now it's time to shift our focus to the second type of pullback, known as the moderate pullback model, which represents a more measured and steady retracement compared to the aggressive type. This model typically shows a gentler pause in the trend, allowing traders to observe potential continuation or reversal signals without the extreme volatility seen in aggressive pullbacks. Moderate pullback. A moderate pullback is a type of price correction that occurs within a clearly established trend. Unlike an aggressive pullback, which is sharp and rapid, or an extended pullback, which is long and deep, a moderate pullback is gentle, controlled, and temporary. It represents a natural pause in the market, giving the trend a chance to breathe before continuing in its original direction. During a moderate pullback, the candlesticks are generally smaller than those in the main trend, indicating that the market is taking a short pause rather than signaling a reversal. Trading volume often decreases during this period, showing that neither buyers nor sellers are dominating and the market is consolidating before the next trend continuation. Moderate pullbacks frequently provide excellent opportunities for traders to enter the market in the direction of the main trend, often at a better price than during the trend's strongest moves. They usually last for a few bars, sessions, or short periods of time, just enough to reset market momentum. Example: in an uptrend, price gradually rises, then slightly retraces downward before continuing higher. Understanding moderate pullbacks is important because they allow traders to plan entries more systematically, manage risk effectively, and avoid entering trades during temporary pauses that might otherwise seem like reversals. Using moderate pullbacks with demand supply zones, BOS, and multiple timeframes. Begin by identifying the trend on a higher timeframe, HTF, such as the 4H or daily chart. Observe the market structure. In an uptrend, price forms higher highs, HH, and higher lows, HL. In a downtrend, it forms lower lows, LL, and lower highs, LH. Only consider trades that align with the main trend to maintain consistency in your plan. Mark major demand and supply zones on the HTF where price has previously reacted strongly. Then refine these zones on a lower time frame, LTF, such as 15 minutes or 1 hour, to create precise, actionable areas for entries. These zones provide objective levels, eliminating guesswork from your trades. Look for a moderate pullback on the LTF. This retracement should not break the key HTF structure, but should move toward a demand or supply zone. Observe signs of slowing momentum, such as smaller candles or lower volume. This pullback creates a clearly defined entry area based on price behavior and zones. Confirm the setup with a break of structure, BOS, on the LTF. In an uptrend, price may temporarily break a minor lower high or swing low. In a downtrend, it may break a minor higher low or swing high. The BOS indicates that the pullback is ending and that the main trend may continue. Enter once the BOS aligns with the trend direction. Place your stop loss just beyond the swing low for long trades or the swing high for short trades. Take profit can be set at the next HTF structure or opposing demand supply zone. You may also scale in positions as price confirms continuation. Use multiple timeframes for confirmation. The HTF validates the trend and major zones, while the LTF confirms the pullback, BOS, and precise entry point. Only enter trades when both timeframes align, keeping your approach systematic. Finally, follow a consistent checklist. HTF trend identified, HTF zones drawn, LTF zones refined, moderate pullback observed, BOS confirmation present, price touches LTF zone for entry, and stop target defined. Only take trades when all conditions are met. Now let's proceed to the next type of pullback, the extended pullback, which can also be referred to as stage sweep pullback.